Hello, everybody, and welcome back to the Dash Trader Newsroom, coming to you from Dallas, Texas, where I'm attending the Traders Roundup with Cobra Trading, and of course, representing Dash Trader. Today, we're going to be talking about the Wall of Worry, an update on the war, the new war, the war in Israel, which is about 5 days old, and inflation, as we have been talking about inflation for the past 2.5 years. So inflation concerns continued, part 2, 3, 4, 5, 6, and ongoing. So we continue to battle inflation. My name is Michael DeGioia. I'm the Director of Educational Services here at Dash Trader, and I am a licensed professional, and I'm joined by my co-host, Jill Melandrino, Global Markets Reporter from NASDAQ, right at the Market Center.
Right at the market site today, yep.
Yes, at the market site in New York City. So, Jill, let's jump right in. We have a new item to add to the Wall of Worry. We have the war in Israel. First war in 40 years, or hot war. There's been little skirmishes, but what impact will this have on the markets?
Mike, I think it's a little bit early to tell. I mean, if you want to use Ukraine and Russia as some sort of comparison, the market's relatively digested that well. I believe it's still a little bit early to tell. I think we'll get a better sense from a local perspective as we're seeing protests play out throughout the week, and apparently there's more planned for tomorrow. So I think, not only how it impacts the region, but how it impacts other local communities. I think that could be an interesting tell. I would say, the lack of leadership, we don't have a Speaker of the House, it's been quite contentious. So it feels like there's a lack of leadership in the US. I think that's problematic as well. But, my sense is we just don't know what the macro global impact is going to be just yet, and how far this escalates. I mean, I can't imagine it from a humanitarian perspective getting any worse than it has already played out. And of course, that's clearly top of mind for everyone, but I think it's still a bit early to tell. There's a lot of speculation. Everyone, all of a sudden became foreign policy experts over the weekend. So
Yeah.
I still think it's too early to tell to see, what the ripple effect will be.
Well, I certainly am not a foreign policy expert, but I don't think that retaliation ever really gets rid of the problem. But
Right.
it seems like nobody else has come to that realization except maybe like Jesus or something. But I mean, it's like, I mean, every time it's always a war, and they do something terrible, and then the other side retaliates and obliterates each other. But I definitely think that you're onto something, which is that the lack of leadership in Washington definitely, encouraged this situation to a certain degree, because I'm just thinking from another perspective of another item on the Wall of Worry is we have another government shutdown in about 35 days, which they only passed a 45-day bridge from the last government shutdown, which led to the Speaker of the House being getting a vote, no confidence vote. So I definitely think there is a correlation between lack of leadership in Washington and what's going on in the Middle East. And certainly it's a horrible situation. And that brings us to the next situation, which has been persisting for 2.5 years. Inflation numbers yesterday came in higher than expected at 0.5 instead of 0.3. But lower than last month's reading of 0.7. What are your thoughts on inflation, and what do we expect? Because we're going into earnings season. So what are your thoughts going forward with inflation?
I think, it's the headline number again. It wasn't core, which is really where the Fed is focused on. And I think the way the market is trying to determine these numbers is more along the lines, when do we start talking about rate cuts? It seems to be general consensus that, it will be higher for longer. And I had a guest on the show today thinking that we will not get any more rate hikes, that July was the last one, and that we'll start to have the discussion around cutting rates the second half of 2024, which probably makes sense. I know there's been some estimates around 50 basis points, 100 basis points. I personally think 100 basis points is aggressive. This Fed has not forgotten history from the 1970s, early 80s of what reversing course too aggressively, too fast, did in terms of inflation. I mean, if you think mortgage rates are expensive now, if you lived through the 80s, or if you remember, your parents' mortgage rates or so forth, from a historical perspective, these aren't even close to what those are. I'd probably call it more average than anything else. I just think it's the velocity and the pace and how quickly they were raised that not only took homeowners by surprise, but of course, corporate balance sheets, access to credit, cost of credit. So I think, perhaps we're at the inflection point when it comes to how this is determining Fed policy. I don't know. Anecdotally, I feel like things are as expensive as they've ever been, even outside of housing and gasoline. You go to the food store and you come home spending $100-200 and there's like nothing in the basket. And I think that's pretty consistent across the board. But you have to think about the consumer as well. The over $1 trillion in credit card debt. The switch is going from spending to now they have to think about servicing their debt. I believe average interest rates on credit cards are 24%. You can see how this could be impactful to certainly retail stocks, certainly to the economy overall. Consumer spend is 70% of GDP. So it just feels as if everything is at a tipping point, to your point earlier.
Yeah, I mean, this is, I have to say that on our wall of worry, I mean, we've been doing this show for quite some time now. And I mean, we've been talking about inflation.
I mean, I think since before COVID, we've been doing this.
Yes, I mean, pretty much from COVID, we've been talking about inflation, and it's the oldest item on the wall of worry. I mean, this predates the war in Ukraine and all the other things that are on the wall of worry. But it's been I remember talking to you about this as a transitory, that inflation was transitory, and it was due to the pandemic. But even before the pandemic, we were talking about inflation, so.
Right. But even before that, I mean, you and I have been consistent with our messaging in terms of it being labeled as transitory. Wages are not transitory. They're not going to come down. And when you think about packaged products, stocks, or, consumer staples, if you will, I feel as if consumers have gotten used to how expensive things have gotten. I don't, because of supply chain issues, because of course, the unusual situation that we've been through, going through the pandemic and so forth, but I don't see packaged good companies bringing down prices in an effort to keep customers happy. So it's not transitory, no matter where you look at it.
Absolutely. I mean, but what I see now developing is kind of a trifecta of problems, where you have consumer debt, over $1 trillion in consumer debt. You have higher than normal interest rates that consumers haven't faced for 13 years. The last part of the trifecta is when companies start laying off and letting people go. And that is always the final nail in an economy, when economies are starting to slip into recession, at least from my experience. And that's, obviously I've been, involved in the markets now for 26 years. I'm almost embarrassed to say that, or, showing my age in that,
well, as a trader, it's good you're still in the game, right?
Yeah, right. I'm still doing it, right? So that's a good thing. I have longevity.
I'm teaching people.
I got that going for me, which is good. So but I mean, let's discuss and kind of unpack the Fed minutes. The Fed minutes came in that basically the Fed will probably continue to raise rates. It's almost factored in that there'll be 2 more raises of rates in next year, in 2024, and potentially 1 more before the end of this year. And the rates will stay higher for longer. At least that was the indication given from the minutes. Was there anything else that you'd like to bring to our attention that was in those Fed minutes that were released?
No, I think you covered it pretty well. I think really, when you think about the next 6 to 9 months, of course, we have to go through earnings. We probably have moved past the earnings recession, and you'll start to see some growth here as we look at Q3, which will be starting tomorrow on Friday with the big banks. But over the next 6 to 9 months, not only do we have to figure out geopolitically what's happening domestically and internationally, but then, we also have an election coming up. If we have a shutdown, if we can't get our deficit under control, are we subject to another rate cut? So there are, it's not just the Fed that I think people are focusing on.
Yeah, I mean, I think that the market had been factoring in a pause in rate cuts at some point in the near future. And I think that this kind of at least the Fed minutes kind of blew that out of the water. I mean, and if you're expecting that at this point, you're somewhat delusional. There is, and I think that also there's less and less expectation for a soft landing. And that brings me to my final point. We're coming into yet another earnings season. And of course, the banks are the first to announce when in earnings season. Generally, banks are usually amongst the first companies to report. What are your thoughts going into second quarter earnings results? And of course, the banks, what do you
Yeah.
expect?
So I think with the banks, really what you want to listen to, of course, always net interest margin. That's really the biggest metric that they're gauged on. But what they're saying in terms of investment banking, the capital markets space in general, whether it's IPO, whether it's M&A and deals, of course, what's happening geopolitically does kind of, it will impact how comfortable people are coming public and making deals. So I think that's important to listen to, as well as credit and their thoughts on the consumer, which brings me to my next one. Of course, retail is going to be an important sector to pay attention to. We're going into the key season for the retailers, and what's that spending going to look like? Is it going to be discretionary, or are they going to be thinking about servicing their debt? And will that be good for consumer staples? There's always the haves and the have-nots in retail. So those are the two key things I will certainly be listening for, is thoughts on credit and thoughts on the consumer.
Yeah, I mean, I'll be watching for stress tests and balance sheets and funding, because and looking at their actual balance sheet as to whether or not they have enough funds on hand, because the most banks invest in treasuries, and treasuries are certainly dropping in prices as rates continue to go higher. So, and I just want to correct myself. I think I said second quarter. This is third quarter. I've just spoke earlier. But anyway, thank you so much, Jill. By the way,
You're
before
welcome.
we go, it's that time of year again. It's our #1 best trader competition. We are getting ready for the fall 2023 best trader competition. Registration is now open. And very often Jill has joined us at the winner's circle at the NASDAQ when we have been there to do the closing bell ceremony. So it's that time of year again.
All right. Well, sounds
Have
good.
a wonderful
Thanks.
weekend.
Thank you. You too. Take care,
All right.
everyone.
See you later.
See
Thank you, Jill. All right, let's jump to the charts here, everybody, as we wrap things up. This is our market analysis section. So let me just bring this up here. Let's bring up our dash trader. And the first thing that I'm going to do is I'm just going to snap on my daily chart, extend this up to the maximum size, and pull this in. I mean, basically, we had 1, 2, 3, 4 days up. I mean, this is literally the start of the war in Israel, with the attack from Hamas on Israel. You got 1, 2, 3, 4, 5 days up since the start of the war. Now, obviously, we are 5 days up. It's a sell setup, kind of a bearish pattern, and we've gotten a pretty big midday drop. And I'm just going to pop this on the 5-minute chart so we can all see what went on here. This is a pretty classic trend line break and fade. So let's just take this. So that's the trend line up. Okay, and then I'm just going to put on another trend line here. So here's another trend line. Okay. And finally, then here's another trend line. So we got the trend line break from the updated sideways trend, right? So this is a stage 2 uptrend, and then this is a sideways trend, stage 2 for indecision. And this is on the SPY. And then, of course, we got the big break, and then we got the fade. Okay, then here is the NASDAQ. Very, very big break on the NASDAQ. A big break to the downside, and then now we've gotten kind of a secondary bounce. So goes Apple, so goes the market. I mean, very, very, very big sell-off on Apple. But let's take a look at the daily chart. Overall, Apple's kind of underperforming. I mean, Apple did have a stellar uptrending rally here that has lasted for a long time, but Apple kind of a spinning top after a 1, 2, 3, 4, 5, 6, 7, 8, 9, 10-day rally. I like to go to all the big MSFT, Microsoft, very similar, probably a little stronger than Apple. We have Meta, which, I mean, Meta made an incredible stellar recovery. I would say that that's sort of a double top on Meta. And then we have, of course, Goog. So we have Goog, right? So we have Meta, Goog. Goog at the top of its range, really at the top of its game as well. And then we have B, we have X. We have Alcoa, which also usually prettier. I mean, Alcoa is certainly not performing lately. Let's take a look at some of the banks. BAC. I mean, all the banks are pretty much at the low of their range. JP Morgan, you know, kind of stronger than most as usual. Citibank, they're at 41 at the bottom of a downtrend. BAC really showing a lot of weakness as per the banks. Let's see what else we got. Let's go to, let's see, XOM. Let's just see how ExxonMobil's faring. I mean, this basically just pulled back down to the low of this kind of sideways consolidation. Let's jump into oil. So oil has been on a tear lately. Let's just do USO. USO also in an uptrend. So oil looks like it's probably going to continue to go higher, but if the economy weakens, that would affect oil demand. Certainly it did just have a little bit of a drop off of its all-time, you know, recent highs, not all-time highs, but certainly recent highs. And then the last one is GBTC. Okay, GBTC. There is Bitcoin certainly making a run off its lows, looking like an ascending wedge formation on Bitcoin. That certainly, has an effect on the dollar. Gold also moving in off of its recent lows. Also interesting to look at the chart on gold. Gold has been stuck in this range for a long period of time as well. But anyway, guys, let's wrap it up for today. Again, big reminder, we have registration open for the #1 Best Trader competition. And if you are in the Dallas, Fort Worth area, DAS will be at the Traders Roundup, sponsored by Cobra Trading. And you could check our social media outlets. Speaking of our social media outlets, stay up to date with all things DAS. And you can check out our monthly newsletter as well. Just simply fill out the form at the bottom of our webpage at www.dastrader. Subscribe to our YouTube channel, Dash Trader TV, and our social media links at LinkedIn, Twitter, Facebook, Instagram, etc. Thank you so much for joining us. If you're in the Dallas-Fort Worth area, join us at the Traders Roundup this Saturday. Otherwise, you can join us in the #1 Best Trader competition. Remember, early bird discount is open up until October 20th. The sooner you register for the #1 Best Trader competition, the more time you have to paper trade using your Dash Trader platform. Great opportunity to try out the tools of the trade. Trade well, everybody.